Welcome back to the Revivals Invoke. This is the 10th revival. We're getting close to finishing the series. But in this revival, we're going to be going over inwogs and indogs, or new week opening gaps and new day opening gaps. Okay, it's in the name, but the way these form is a new week opening gap is simply when a new trading week is formed, and that gap is the new week opening gap. And for a new day opening gap, aka another daily candle, it's the gap that forms whenever a new daily candle has formed or a new trading day has opened. Okay, it's that simple. Okay, very very simple. Now these gaps, okay, the algorithm tends to use them very precisely. Okay, and they expire. They do expire. I'm not going to say these last forever. They do expire. The new week opening gaps expire after 4 weeks, which is, as you know, one whole month. And then I think the new day opening gaps, they last for an entire week. But I think it's like the end of the trading week, something like that. So if you got a new day opening gap that forms on Tuesday, I do think the algorithm doesn't pay attention to it anymore. It doesn't mind it anymore at the end of the trading week. So if you got one that forms on Friday and the market closes on Friday, I think the new day opening gap cancels out on the same day. So we're going to go through a couple new week opening gaps here, and we're going to see how price treats it. So we have one here. Let's go ahead and minimize that. We have one directly in front of us, okay? How you get your new week opening gap, or how you get like your drawing of your new week opening gap, is you take Friday's closing candle, right? Or Friday's closing price, which is right here, and you go to Sunday's opening price, which is right here. So Friday's closing price to Sunday's opening, and this is your new week opening gap right here. That is your new week opening gap. So what we can do is we're going to drag this all the way out in time like this. All the way out there. Because remember, these gaps last for a long time, and price is going to be consistently using them, okay? Now, let's just see how price, uses this thing. Let's go ahead and look around here, because as you can see, price was very choppy around this area. Matter of fact, no, let's look here, because you can see a lot of instances on how this gets used. But like I said earlier, we're going to draw our consequent encroachment right along. Hold on, let me see. Not consequent encroachment, but mean threshold of our new week opening gap. I would add quadrants to this, but it doesn't look big enough of a new week opening gap for us to add, quadrants. Because for you to add it, it must be large enough for you to say, okay, let's add it. It's a pretty large new week opening gap, but not large enough, obviously. So we're gonna go ahead and pull this out all the way to like right there. I think that's about equilibrium. That is equilibrium. So we're gonna start from the beginning, and we're just gonna study how price reacts to it, how it tends to use this. Okay, how it tends to use it. So right off the bat, we create the new week opening gap, we go lower into a discount, and we leave some liquidity behind, okay? After that, we come up into the new week opening gap, respecting the equilibrium right along here, using that to retrace back down into this rejection block right here. We come right into that rejection. We bounce higher. We come into, well, no, not even before that, but we bounce into the new week opening gap again. We respect it, using that to come back into the order block. We respect the order block, showing that we want to push through the new week opening gap and ignore it for right now. We go up, and we completely reject down. Now let me say something. Price can go through the new week opening gap. It's not like it has to respect it. No, it's not like that. What price can do is kind of like support resistance, but it's not. But it's a form of it. Price will go up, down, through it, back and forth, sideways, whatever it has to do. But whenever it's ready to go in a certain direction, or when it's ready to use it, it will use it, okay? And if you look, there are instances where it uses it, and it goes back and forth through it, okay? As you see right here, it comes up, down, then it goes up again, then it comes down into the equilibrium of the new week opening gap, and then bounces up. Very cool, isn't it? Very cool. This is Asian sessions price action, by the way. If you want proof here, that right there, that tap right there, that happened in Asian, giving you a nice, beautiful delivery. Honestly, I don't even use these gaps much, but just looking here and showing you this is kind of convincing me that, wow, these things are pretty powerful. But let's go ahead and look here. After rating these highs here, having a liquidity purge right above here, what we do is we come back down, rejecting from that level, coming back up to this order block, right? We come back down below the week opening gap, and then right above this wick, you do see that, right? How the candle opens, right? It opens and it just displaces low. It opens right at the equilibrium, and then it just goes lower. Okay. We have one final tap into this order block here after coming below the new week opening gap, and then we just dump. We do to our pants, just absolutely do to bed. We're just leaving. Okay. That old liquidity that was right here, gone. It's not there anymore. After that, we begin to come back up. Let me go ahead and turn on the kill zones because I think it'll give us a little bit more insight. After that, we go up, we rally. Clearly, we want to go higher. We have a tiny retracement back into this fair value gap. After that, we head back above the new week opening gap. This was that tap I was telling you about earlier. And we're just going to, keep playing this new week opening gap forward and see how price, treats it. So we're here on Monday right now. This is Monday's Asian session. Price comes back above the new week opening gap. Then it has a retracement coming directly to the equilibrium, respecting it. And to this volume balance too. If you don't notice, there's a volume balance right here. And it respects that. So that's two major levels of respect. Because remember, a volume imbalance is literally the weakest concept there is. As a matter of fact, it's even a higher confluence because it respects it by the body. That is crazy. Like, wow, this is... What am I teaching you right now? This is crazy. I can't believe I'm teaching you this. This is absolutely wild. But yeah, it comes down, retraces into the volume imbalance and the equilibrium of the new week opening gap as we see here. And then price, just heads higher back into that high right along there. And that would have been one of your trades. Moving forward, back into London and London lunch. We begin to consolidate a little bit more. After that consolidation, we tend to expand out of that consolidation, purging these highs here. I think there was an SMT here. I'm not sure. Or maybe there was just equal highs. But yeah, there was equal highs left here. I'm assuming for New York. Price is probably engineering some buy-side liquidity up here for, so New York can completely just run through it. But yeah, after the consolidation, we run higher, but we do not go past this high, creating equal highs. So we're engineering liquidity, so New York can have some form of orders to hunt. After that, London lunch kicks in and randomly just has this spike back down. All right, I think this is some form of price delivery cycle right here. We have this gigantic consolidation. Well, we have this mini consolidation right here. We rally out of that, and then we can continue consolidating some more. So that turns this entire little range right there into consolidation. After that, we expand lower, okay? And then we retrace, and then we dump again, okay? But while we're retracing, what are we doing? We're also accumulating right here at the equilibrium of this new week opening gap. So it's using this new week opening gap equilibrium to consolidate and retrace. Pay attention to this. It's using it to consolidate and retrace. See, I don't think you're hearing me here. I'm going to say that again. It's using it to consolidate and retrace. Do you remember price delivery cycles? Do you remember price delivery cycles? Okay, listen to this. We've already accumulated, right? We've already consolidated throughout a little bit of Asian and a lot through London. Okay, well, basically all through London. We expand. From here, after expansion for price delivery cycles, what else do we expect? We expect either a reversal or a retracement. Listen to this. There can be multiple price delivery cycles. A maximum of 2. Okay, a maximum of 2 throughout all the kill zones, okay? This consolidation here forms the next one. This consolidation here forms the next one. Watch this. Now watch this. This whole consolidation here forms the next one. Watch this. After this consolidation, following up this price delivery cycle, because this is one price delivery cycle. I don't know if I have like a little thing to set above it or some sort of like thing that I can put above it to make it say that's one. But this is our first price delivery cycle, and that retracement is continuing this one back here. After that retracement, we expand again. So this original price delivery cycle is over with. Now let's come back to here. We consolidated again, creating another price delivery cycle. We dump. Okay, we expand out of the range. Now, after we expand, what do we expect? We expect two things, a reversal or a retracement. What do? We completely reverse, creating a break in market structure. Price comes down into that fair value gap, completely disrespects the breaker though. It completely just runs through the breaker, doesn't even care about it. And I think we respect we respect the mean threshold of this order block pretty decently, so price wants to head higher, okay? Let's say that we use only new week opening gaps to trade. Once we saw price come back above the new week opening gap, let's say after all this time distortion right here, we want to see price dip into the equilibrium and respect it. It did. See that right there? It did. It came right down. Matter of fact, into this order block too. You might be like, but isn't that order block used because it came down into it and went up? No, it has to displace away from a PD array for it to actually be used and or disabled. So this order block is still active. It's still there. It's not gone. It's still there. And this mitigation block is still here too because it hasn't used it yet. So there is a order block and a mitigation in the same area. Okay. And then we have the confluence of it tapping into this the confluence of it tapping into the equilibrium. So once we see that, we're going to let's drop down to maybe a 1 minute. So we're going to go back here. What is this, Tuesday, April 29th? So we're going to drop down here and we're going to pull ourselves back to April 29th, 9:30. Boom. We're going to go straight back to the touch of that equilibrium, which is right around here. So let's see if we can find a setup right in this area, okay? We got this consolidation, so this is accumulation, manipulation, and then, as you know, distribution. Price is struggling. It is struggling to get through this fair value gap, but it is disrespecting it. That's the thing. We inverse this fair value gap. Price used it to go higher to also refill this imbalance here. We had a order block, which is currently getting disrespected, so we can see that there is a willingness to go higher because it's disrespecting opposite price delivery arrays, okay? We have one final retracement into this mitigation block right here, and that would be our entry, because since we've seen so much disrespect previously. And this teaching might just be over 40 minutes long. This might be one of my longest teachings, because I'm gonna do two separate new week opening gaps, mind you. I'm gonna do two separate new week opening gaps. I'm just doing this one since this is the most recent one, so this is going to be pretty short. Then the one after this is going to be way longer. So this might turn out to be an hour-long video. Hopefully not. I'm going to try to make it as short and sweet as possible. But at mitigation block is our entry. Let's say we got in as soon as we started coming back above the mitigation block. We can set our mitigation block below the candle low, which I think is basically already at it. Yeah, it basically is already at it. And then what we do is we do a standard deviation, like so. 1, 2. Bam. Look at that. Nice standard deviation. We got a standard deviation of 2 landing above this high here, or right above this rejection block, which is basically liquidity. And then we got the 2.5 resting above the London close. So the 2.5 is a good target if you want to be, that, what's the word? Not risky, but that ambitious. You can do that too. And then we have the 3. That's pretty far away from this high, so that's not advised to target. The most advised target to make the most money would be the 2.5 standard deviation. And then if we look and pull this over, it hit our take profit for about 4.5 risk to reward. Okay, now that's just one trade that we took using the confluence of, price delivery rates. I forgot I was listening to that song earlier. Anyways, here we go. Let's keep going. Let's keep going. We're going to jump back onto the 15 minutes since, that's our kind of default time frame. Here we are. We're back onto the 15. There we go. That's what I was looking for. Right along there. Alrighty. So that was our trade that we took right here. That was that up move targeting the London close. Now we're still looking at price. We're still looking at what it's going to do. Price trends lower. It edges itself lower back into the new week opening gap. Comes into the new week opening gap. Bounces off of it. Pretty nice and smooth. After it does that, it comes and takes out Asian's high as a liquidity purge right along there. And then we also come into a mitigation block, I think. Yep, right there. We come into that mitigation block and we respect it also. So it's currently showing that price wants to go lower. And then we have this consolidation here. This is the beginning of a price delivery cycle. We consolidate, expand, new retrace. So price should continue lower after that, correct? Yes, it should. So you can either take this entry here, or if you want to just trade specifically off of new week opening gaps and you're waiting for it to run through the new week opening gap, then hey, we can take our entry right along here during these candles. So let's go ahead and drop down on the 1 minute and then go to, what was that, the 30th, and I think it was 8 o'clock where that was formed. Yeah, right along here, exactly, yeah. So here we go. Earlier, as we looked, we can see that price is clearly respecting the mitigation block. It retraced into that 15-minute fair value gap, so now price wants to go lower. But in this video, we're going to be strictly taking new week opening gap confirmations. At 8:30, price spazzes out because there's a news event, but let's pay attention to what the news event does. Let's pay attention really quick. Really, really quick. Is that a mitigation? No, it is not, sadly. Price comes up, rebalances, runs through this order block and mitigation. So it ran through it. All it's doing is just seeking liquidity right now. It's manipulating. That's literally all it's doing. So we're tracing to a premium, a temporary premium. Afterwards, it dumps. Okay, we can clearly see that if we were to apply quadrants on here, but it's not big enough, it closes below the upper quadrant and then begins to respect it and keep going lower, showing with this first candle also. So we can clearly see that it doesn't want to disrespect the new week opening gap going the opposite way, and it still wants to drop. So price was moving extremely, extremely fast to where we couldn't get an entry up here, but we can get an entry right along here at this fair valued gap. And if we look, if you pay attention, you can see that it was respecting the consequent encroachment. So that is our confirmation to get in on sales. We can say we sold literally right at the equilibrium. Once we saw it begin respecting it, we drag it over like that. We can set it at the high of the fair value gap, which is like right along there. It's a pretty big candle, so we can set it there nice and safely. And what we're going to do now is we're going to do our standard deviation so we can get our good targets. Boom. Now let's go ahead and jump up to that 15-minute and see where our targets or our standard deviations land. All right, so we got, I think 3. Yeah, we got 3. That's decently close to this low here, or which is Monday's New York lows, which we can target. So that is a advised target. Wherever my sell liquidity thing is, Jesus Christ. And then we also have the 4 resting right below last week's Friday New York lows. So we could target that also. And if you notice, both targets got smashed. Nice and just absolutely beautiful. I was about to pick buy sell liquidity, but here it is, sell side liquidity. And if you want to look to see if there was any other good targets, nah, not really. Not really, as we see here. Because of the 6 was below this low, but it wasn't close enough, so it's not showing a good target. And the 5.5 was below it and did not come below it. Was above it and did not come below it, telling us that this is not a good target. And our best targets are the 4th standard deviation and the 3rd standard deviation. If we draw back down to our 1 minute, we go back to wherever that area was, exactly around here, and we set it to our 4th standard deviation. That provides us a nice 5 risk to reward, and I think that trade lasted us about an hour and 10 minutes. Absolutely amazing. This is a beautiful hindsight trade, isn't it? Pretty amazing, targeting that 4th standard deviation, and then shortly after it begins to reverse back higher. Absolutely beautiful. So that's our second trade. How many wins we got so far, y'all? We got 2 wins. Matter of fact, I might get Essential just so I can like start doing lectures and teachings like this, so I won't have to keep doing it in hindsight, so I can actually say we got a win. But yeah, I'm gonna start doing that now. I'm definitely gonna buy Central very, very soon, or I might get Premium so I can start doing that for you guys. I did it back then before, but I'm gonna repurchase it. So let's go ahead and jump back onto our 15-minute, because the 15-minute is a perfect, balance between the time frames. You know what I'm saying? It's the nice perfect balance. Mind you, that was a pre-market trade. So, during London close, which is a reversal kill zone, if you don't know that, London close will typically reverse price, or it'll cause some sort of retracement and then continue higher after the kill zone. And as you see, as soon as 10 o'clock comes in, or the London close comes in, it reverses. So price, once they head higher, We can see that price wants to head higher because we got this break of structure, the respect of this breaker right here. We got a breaker and we got a order block, so it's respecting that. So price clearly wants to go higher. Now we're going to keep confirming until we see a breakthrough of that new week opening gap, and we can say, okay, price truly wants to go higher. We got a liquidity purge right here, comes back up. There's the order block. It comes to it multiple times, respect it. So now we're like, okay, it's getting closer to the new week opening gap too. It's had some taps above it. So now let's drop down to the 1 minute and see where our entry appears, shall we? What is that? No, that's not April 1st, is it? Oh no, that's still April. I said April 1st, I mean May 1st, but that's still this is still April. I forgot about that because that right there was a pre-market trade. Alrighty, so here we go. Right along here. Let's go ahead and look around. So yeah, this is where it started consolidating at. So we can see that price had a purge right here, a purge of liquidity right along here. And after that, price began to reverse higher. This is your liquidity purge right along there. And then if you notice, it came for the short-term swing and not the what? It came for the short-term swing and not the intermediate-term swing. If you don't know what an intermediate-term swing is, an intermediate-term swing is when there's two short-term lows above another low that's lower than both of them, obviously. So two short-term lows above a low. Okay, hold on. Let me explain this well. Two short-term lows on both sides with a low in the middle. That creates your intermediate-term swing. As we see, we got one short-term low and another short-term low with a low in the middle that's lower than both of those. So we got two short-term lows that are above this low, making this a intermediate-term swing, indicating that price should not come to this swing because it is an intermediate-term swing, not a short-term. It can use this because it is short-term, not intermediate. So it came to the short-term swing and immediately rallied higher. We can see that tap into that new week opening gap, using that to come back down into this order block right here. Ease the order block with the expectation of us, wanting to push through it. So we're like, okay, we're gonna take this entry and we're gonna anticipate price, pushing through the new week opening gap. So we're gonna take our entry right there at that order block, right along there at that order block. All right, boy. After that, price begins to head higher, but guess one thing we forgot: our standard deviation, guys. We gotta deviate our standards. Alrighty, so we got the 4 landing right at that previous high. So what is that? That's our best target, because if we try to zoom out, there is close to almost no target. We got this 5 landing right above the London lunch highs, which we could also take. But just by itself, this gives us a 5 risk to reward. If we target that 5, that should give us about like a 6 or 6.5. Yeah, close to 6. So if you're targeting those London lunch highs, then you would have definitely got some very decent profit. And this high is not advised to take because the standard deviation does not land above that. Okay, it does not land above it, sadly. So our best target would be the 5. And then as you can see, after the 5 was hit, price began to slow down, giving us evidence that that 7 was not a good high to target. And that gives us our 6 risk to reward higher, and that is our 3rd win. Now, coming close to the end of the week, which is this week that I'm currently recording in, price heads higher. That was our trade earlier. We absolutely did very, very well. If we did this live or we did this during in market replay, this would have been a absolutely banger trade, like a very, very good trade. All these trades were amazing. Not being biased over one another, but this trade was absolutely amazing. And there's no other taps into this new week opening gap. We just completely leave it, and that will happen. It's an whoa, what the heck? Has this been going on while I've been recording? What the? Give me what? This has been going on while I've been recording? What the heck? Seriously? Wait, is that real? Oh my god, that is real. Wait, wait, hold on. Oh wow, that is real. Wow, okay, I've never seen Asian pump like that. Not on the NQ and ES. Wow, that's amazing. But going back to going back to our new week opening gap, that is how you use the new week opening gap. It's simply if there is a big enough new week opening gap or new day opening gap, you could add the quadrants to it. And well, always whenever you see a new week opening gap, you want to add the mean threshold to it, or the equilibrium, because that is a very important point for the algorithm. It's a very algorithmic price point. Okay, whenever price comes to it or it's using it, it's very precise and it's very helpful. Okay, so please do that. Okay, and a reminder, the week opening gaps last for 4 weeks, which is an entire month. 1, 2, 3, 4 weeks, which is, as you know, 20 trading days, which is a whole month. Okay, so 4 weeks is how long a new week opening gap lasts from its, from the beginning of it. So Sunday, 4 Sundays after that new week opening gap is when the algorithm is not paying attention to it anymore. It disposes of that new week opening gap. And new day opening gaps, like I said, I think they either last for 5 days or they last till the end of the week. But I think they last until the end of the week, which is for futures at its Friday's close, or Friday's close at 6 o'clock or 5 o'clock, something like that. But I didn't go over new day opening gaps, but it is literally the same concept with new day opening gaps. It's nothing different from what I just did. If I named it new day opening gap, then it'll literally be the same thing. Okay, they're just two separate gaps that form at two separate times during the week. Okay, so that is new week and basically new day opening gaps. Okay, I hope you enjoyed this 26-minute and 40-second lesson. It's very probably one of my longest lessons, but I think I have longer than that. But this might be one of my longest, and I keep making it longer by talking. But I'll be in this video here. This was the 10th revival, new week opening gaps, and I'll see you on the next one. Peace.